Hey traders, this is Ron Haidt at Market Tamer. Happy Sunday. Hope you're having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. We'll start off with this SPY, and what we'll do in today's video is take a look at what to watch for if the markets begin to roll over. Because with Friday's price action, there could be a little bit of changing in sentiment right now. Typically, Fridays haven't been that bad. Markets may be unchanged to the upside, or if it's down, it's maybe only down a little bit. But what happened this Friday on the daily chart is we gapped up, could not hold the gap higher, and actually closed practically at the lows of the day. Yeah, there was a little bit of a pickup on volume. That's okay. If we take a look at the calendar, the third Friday is also options expiration too. That can play some games. But nonetheless, price action speaks, and we closed the lows of the day. On the daily chart, I would still give the bulls the edge walking into this week, but there's a little bit of caution now because remember, the red line, that's the 20-day EMA. And for this video, I put back on the 8-day and the 200-day. You can see it up here on the left, what each color represents. So right now we've closed below the 8 period. The 8-day outlook would be bearish, but we're above the 20, and that's that litmus test. We get below there, the daily charts are no longer bullish, and the bears would start getting the upper hand, with the most prominent target being the institutional moving average, the 50-day in orange. That's SPY daily. Let's take a look at the diamonds on a daily chart. Zoom in here. They're pretty much right on their 8-day. Again, we're going to watch here at the 20-day. So no problems here on DIA other than it closed the lows of the day. The Qs gapped higher, tried to get to new all-time highs, ended up closing lower on the day, practically at the lows. Similar to spiders, this also completes bearish engulfing. That's not a good sign for the bulls, potentially a good sign for the bears. However, I still want to use that red line. We get below a 20-day moving average on a closing basis. That again would turn the charts no longer bullish, but the bears would start to get the edge. Now, if we go take a look at the IWM, they're still lagging very, very much. The highs are back there at the end of August, beginning of September a year ago, and they're just rolling over here. Interestingly enough, how I have this trend line drawn in by dumb luck or whatever, we are just bouncing off the top side of that. But right now, I would give the bears an edge on the IWM because we've now closed below the red line again. The MDY, which are your mid caps, we zoom in here. They're basically right on the red line, maybe a few pennies below it. Nah, pretty much right on it. Again, a little close down tomorrow. Target would be the 50-day. Small and mid caps remain very weak. Now, if we take a look at the XLF, and we zoom in, this is the banking ETF. It's holding the 20-day EMA. We hit that on Thursday. We bounced higher, closed a little lower, but we're still above the red line. If they lose the red line, that would also have bearish implications for the market. IYT transports lagging, but they're still above their 20-day EMA. And how about the semis, the SMH? They're above their 8-day. These guys are still really strong. You package all this together on the daily chart, the bulls do get the edge to start the week. We just want to keep a close eye on it come Monday, Tuesday, and see if any selling persists. If we take a look at the weekly charts, let's go 2-year and change this to weekly. The semis, we'll start here. They look really good. They're above all moving averages. Transports, above all moving averages. Banks, above all moving averages. Again, weekly is still holding up quite well. We take a look at the diamonds. Very, very well, right? They're practically hanging out at all-time highs on a weekly basis. How about the Qs? Same thing, hanging out there practically at all-time highs. And then if we do the spiders, again, hanging up there near all-time highs on a weekly basis. That's why I want to give you guys points to watch for to see when the tide could be potentially turning. But on a weekly basis, looks really strong. Dailies, well, like I said, we have a couple things to watch for now. We actually have a Friday that ended up with selling pressure, and we want to keep an eye on the red line. All right, moving on. Gold. It's been in the videos. It's been going higher lately. We got here in June, started to explode. We had our pennant, we broke out. Friday's action back tested the pennant itself. This is still bullish on the daily chart. If I take you out to a 5-year weekly chart, you can see we're at 5-year highs. I did that for you previously in a video. Go out 10 years, we're above 130. That would now be support. I mean, the next major target would be that ledge at 150, where we had 2011, 2012, 2013 before it began to quickly drop. Above 150, we go back up to the 170, 180 area. Gold's still looking good. Silver, it broke out on a daily chart. You can see we got above the previous highs finally with big volume back on Thursday. If I take you back 2 years, I had to go back I go back 5 years to get something on gold, right? I only have to go back 2 years to get some resistance levels on silver. That's how much it continues to lag. Right now, I would say the big target is 16 and a quarter, just over $1 higher on SLV. And lastly, I'm going to end up here with Netflix. I told you guys I would take a look at some of these protective put type strategies because I strongly believe every single person out there needs to know how to protect their assets, their investments, because we don't want to lose our money. Well, here was Netflix again. Here was the earnings report. Okay, now Thinkorswim has the earnings report here. Remember, I always say it could be off by a day or two. This is Thinkorswim being off. And here was the actual earnings report on 7/18. So the dollar sign says 7/15. It actually happened on Thursday. And then Friday it sold off harder. This stock has basically gone from around 370 all the way down to 315. The other important part of considering a protective strategy for an earnings report, I would always consider you guys, again, from an educational perspective, to consider purchasing it at least 1 day before the report because you never know how that's going to play out. You never know. What if the company announced early? What if the date that you found was wrong, etc.? So here's the example we're going to do. If we take the day before earnings, which was here, that way we're at least 1 day before the report after hours. The stock was trading at 365.99. You can see the close right there, right? 365.99. If I use the Analyze tab and I go back and we look on 7/16 inside Thinkorswim before the stock had earnings, the stock's at 365.99. A 365 long put would have cost $21.70. As of Friday, the stock closed at 315, as you just saw. And if I zoom in here or just scroll up, the 365 is now worth almost $51, 50.90. The stock lost $50.89. It's almost identical to the number I'm showing you, but the point is the stock dropped, right? $50. Well, the long put went from 21.70 to 50.90. That is a $29.20 gain. What am I trying to say? The stock lost, let's say 50, and the long put gained approximately 29. Yeah, you're still out 21 bucks a share, but isn't that a whole lot better than being down $50 a share? And that's the idea of protective puts. They're never gonna typically protect dollar for dollar, but it's a great insurance policy to try to hedge those losses. Now, you know what else we could do? Potentially, we can go month by month or week by week and start selling calls out of the money and putting money in our pocket to help pay back some of that money that was lost in that capital. Right now, with this stock closing lower, it's quite bearish. And I told you guys that the next stop would literally be somewhere down in 230, 240, 250 area, somewhere down here. That was $100 lower than where we opened on Thursday. I would want to keep this long put in place. I wouldn't want to do anything to it. Volume was high again. We closed the lows of the day. This is really, really bad. The point at which I might consider adjusting or rolling this long put is this blue line, the 8-day EMA. If the stock were to get back above that, that might begin to signal a bottom. And then I could take my put that's up here at 365, maybe roll it to right at the money, right where the stock would be trading. Again, practice protective puts. There's a lot of companies coming out this week. Get yourself a paper trading account, or in fact, truly write it down on paper and see how these puts could save your bacon when the stocks have these big down moves. I hope you find this helpful. Wish you guys a fantastic week ahead. I'll be back with you in the next video tomorrow. Take good care.